This is Paul Donovan from UBS's Global Economics Department. US Senator Bunning's worst fears would appear to be being realized. He famously declared, in the wake of the Fannie and Freddie bailout, "I thought I woke up in France." And now, no less a luminary than ECB President Jean-Claude Trichet has endorsed the $700 billion bailout proposal, saying that it is vital for global finance. Trichet is right. Government aid is now vital for global finance. However, Trichet quickly defaulted to being wrong, declaring that what Europeans wanted to hear was that their money was being protected from the threat of inflation, a threat which, on the evidence of yesterday's data and pure common sense, is receding to the point of non-existence. What Europeans want to be told is that their money is safe and that borrowers will be given some assistance in repairing their balance sheets. The latter point could be accomplished by, to take a wild example purely at random, recognizing that we're teetering on the brink of a major financial disaster and cutting rates before we've gone over the edge and into the abyss. That is the critical difference between the US and France. For all Senator Bunning's concerns about croissants being served in the boulevard cafes of Kentucky, France is laboring under a monetary policy that actively seeks to make the current crisis worse. The US has monetary policy that is, at least, doing its best to remedy the current situation. The Irish government does appear to have a certain amount of sense, with the state-sponsored guarantees of its major banks' creditors being announced yesterday. Banks pay for the privilege, though how much is not clear, but hopefully it will shore up confidence. Sweden proposed a similar measure in the early stages of its financial system bailout in the 1990s. European competition regulations notwithstanding, our European team think there is a realistic chance that the Spanish will join in with this sort of practice. Today's Daily Mail newspaper in the United Kingdom is suggesting, with all the authority a tabloid newspaper can muster, that the UK government may be proposing a similar scheme for British banks. Meanwhile, at the cutting edge of the credit crisis, the credit rating agencies have swung into action. Iceland has been put on negative outlook by Moody's after S&P downgraded the country in the wake of a bank bailout. Senator Bunning's concerns notwithstanding, the US Senate now appears likely to vote on a bailout plan that is essentially the Paulson plan plus a bit more money for deposit insurance. So far, so good, especially in the wake of yesterday's market reactions. However, there are also reports that House Republicans are seeking to come up with an alternative plan which could hamper passage of the legislation somewhat. As markets watch politicians with some trepidation, the real-world economy continues to slide towards a deeper and more enduring downturn. Japan signaled more bad news with a Tankan survey of corporate sentiment that was softer, reflecting weaker export volumes and problems for larger companies. Capital spending plans disappointed the market. Weak capex is a key part of our Japan team's call for a recession and slow recovery in the Japanese economy. More worry for anyone foolish enough to cling to the desperate concept of decoupled growth. The domestic demand side is also looking vulnerable. Wages are growing in negative territory again. Remember deflation. And overtime pay was off 1.8% on the year. Bonus payments were also in negative territory. This, at least, suggests slack in the labour market demand conditions, which in turn implies domestic corporate deterioration and further economic weakness. US manufacturing sentiment from the ISM is scheduled and is set to be weak. Sentiment data will pick up on some of the recent market turmoil, but the real economic effects of current events will not be fully visible for a couple of months. We're below consensus with a 49 ISM projection. Euro area final August unemployment is due. The deteriorating labour market is yet another reason for accommodation from the ECB, but we don't see this coming through in the old data. Rather, it's the more recent news from countries like France and Italy, which shows how desperate the continent's economic situation is becoming. That's all for today. Have a good day.